What's up, guys? I'm Mike from Stocked Up. In this video, I'm going to be explaining the difference between credit spreads and debit spreads. In this example, we're going to be looking at Apple stock, and we're going to be looking at the 255 strike put and the 252.5 strike put for Apple that expires on November 15th of 2019. So I know these topics can be confusing, and they are a little confusing at first, but they're really not too bad. So with debit spreads, they are similar to like a debit card. You can only lose what you put in. But credit spreads are a little different. You could lose more than what you have in technically. So both of these spreads are with two options. So if you're trading a debit spread or a credit spread, you're going to be buying or selling two options. So a debit spread. An example would be if you longed the 255 put for Apple and you shorted the 252.5 strike put, right? So what's going to happen is you're going to end up paying about $120 for the 255 put, and you're going to sell the 252.5 put for $70. Now, look, you're going to pay $120 for something, and you're going to get $70 back. So all day, you only have about 50 bucks in. Now, the max you can lose is at 50 bucks, right? But this spread, this thing that you just bought for 50 bucks, the maximum value it can go to is 250. And we know that because you take 255 and then you subtract 252.5, right? So just subtract the width of the strike. So 255 minus 252.5, right? Gives you 250. That's the max value the spread can go. So you're risking 50 to make 200, right? You're buying for 50 and the highest you could go is 250. Now, debit spreads are correlated with the options type. So if you're trading puts, then you think the stock is going to go down. If you're trading puts on a debit spread, you think the stock's going to go down. If you're trading calls on a debit spread, you think the stock's going to go up. So credit spreads are literally the exact opposite of a debit spread. So we're going to look at the same exact trade, just reversed. So a credit spread, let's say, so what you're going to do is instead of buying the 255 put, you're going to short the 255 put and you're going to buy the 252.5 put, right? So you're going to sell the 255 put for 120 bucks. And you're going to have to give $70 back because you're going to buy the 252.5 put, right? So you sold something for 120 and you had to give 70 back, right? All day, you got 50 bucks. You get to keep 50 bucks. So that's your credit, and this is your max profit. So if this trade wins for you, you're gonna get to keep that 50 bucks. Now, if the trade doesn't go your way, the highest it could go is 250. So you're risking 50. You're risking 200 to make 50, right? So it really all depends on the situation. If you want to go with a credit spread or a debit spread, in markets like these, I've been selling credit spreads on Tesla and Walgreens because, like, if we go to Walgreens, we could see that some of these options are so overpriced. So, like, if we look at like the 62 strike call option this week, it went from $9 to $350, way too overpriced. So I'd like to short that, and that's what I did. But credit spreads, like it's the opposite. The bias is the opposite of the option type. So, like, for example, if you're buying a put debit spread, you think the stock's going to go down. But if you're buying a put credit spread, you think the stock's going to go up. If you're buying a call credit spread, you think the stock's going to go down. So really, this whole thing is not as complicated as you think. Spread trading is probably one of the best forms of trading there are. Like whether you're just trying to trade naked calls or puts, you can make a lot more money and hedge your risk a lot more if you incorporate spreads into that. So even if you just like to trade the naked options, like for example, like let's say you like to trade like Cisco options, right? Nice cheap options. What you can do is it's called like a diagonal, or even just like let's say you bought like the 49 strike call, right, on Cisco. And you think Cisco's going to go up. What you could do is you could buy that 49 strike call for 90 bucks, right? But if you use spreads, you could also sell like the 51 strike call and get about $30 cash back. So that's about a 33% of your money cash back. So the only downside to doing that is it's going to limit your profit at about 1,000%. But that's not too bad. So, if you are confused on anything in this video, just rewind it, or you can ask me in the comments down below. I answer every single question and comment down below. So if you are confused or have any questions, let me know in the comments down below. But other than that, thanks for watching.